What's up, everybody? Today we're analyzing the Home Depot. Let's check it out. 5-year chart, they are up 94%. They also have a 2.3% dividend yield, so they have outpaced the S&P 500 in the past 5 years. Now, can we expect this going into the future? Probably not, and we'll see why. So, we're looking at a $370 billion market cap with a 25 price to earnings ratio. Huge company. They sell like home goods. So yeah, 25 seems kind of steep for this type of like retail business, but we'll see. Let's check out some numbers here. They have gone from 100 billion in revenue in 2017 up to 150 billion. That is like a 50% increase over the past 6 years, and it looks like probably about what, like a 5-6% growth each year, like on average. We could do a CAGR calculator here, 100 to 150 over 6 years. 100 to 150, 6 years. We're looking at a 7%. Yeah, 7% over the past 6 years. But can that growth continue? Most likely not, because they are already such a large company. And in the last year, they actually declined by 3%. That might have to do with the housing market and just the cyclicality of it. So I don't know if I would put too much stock into that, but yeah, it makes sense. In terms of their net income follows their revenue like extremely closely. They tend to keep like 10% margins all the time. In fact, in the statistics page, we can see their gross margin hovers like right around 32%, operating margin right around 14, 15%, and their gross or their net margin is usually around 10%. Going back to their statements, let's check their balance sheet. So their balance sheet, they have a lot of debt, 48 billion. And yeah, it's a lot of debt for them. Their book value is like 1 because of how much debt they have. So it is kind of concerning. But they do own most of their stores, and I think it's that most of this debt is because of real estate. Basically, they own a lot of real estate, which so the debt's maybe not that big of an issue. In terms of cash flow, they are cash flowing. It usually follows their earnings pretty closely. And buybacks, they're doing like 7 or 8 billion in buybacks. And dividends, they also pay a hefty dividend of 8 billion. They basically pay out all the money back to shareholders. Yeah, it's pretty good to see. Let's check this annual report for them. So their stores, they own 90 or 89% of their stores they own, and then they lease most of their warehouses and offices. So that was kind of interesting for me to see. And then let's zoom that in a little bit. And then this is their stores. So according to state, they have 246 locations in California, which seems like a lot, and Florida 158. Like it seems like they have stores everywhere where they need them in the US. So I don't know if there is much growth in the US. And then the stores outside the US, they have a bunch in different countries like Canada. Yeah, lots of stores in Canada, lots of stores in Mexico. Looks like maybe they don't really have a lot of stores like overseas. So maybe that would be a growth opportunity for them at some point, like in Europe or like Asia. But yeah, let's check out the analyst estimates. 15.36 for the earnings estimate next year and going up to 16.5. And in terms of revenue, the average estimate is 154 billion going up to 158, which is a 2.6% increase. Let's put that into the DCF model. And let's zoom this guy in. All right, so we've got 15.36 and revenue estimate of 154 billion. Buybacks of 7 billion, net debt of 48 billion, which is a lot of debt. Discount rate of 10%, exit multiple 15. Is that fair for this business? They're currently trading at 25. maybe 15 is fair if they end up seeing no growth at the time that you sell. But maybe we could also go for like 18. 18 would probably be more fair for Home Depot, I think. In terms of growth, I'm projecting 8% earnings growth going down to 5 and then 3. I think that is fair for this. And in that case, their fair share price is like 270, somewhere in between here. And then for their revenue growth, we've got 3% just going forever because they are kind of saturated at this point. They are everywhere. I think 3% growth, just keeping in line with inflation, is completely fair for this business. Even though they did decline in revenue by 3% last year, yeah, I think that might just be cyclicality. And I think on average they could do 3%. I mean, over the past 6 years, they did, what, 7%? So 3% is totally fair. They might still be able to do like 5%. But yeah, with them being so large, it might be difficult. And in terms of profit margin, they keep it pretty consistent, right around 10%. So I just did that for all of the years. And in this case, we can see the fair share price is going to be 203 if you account for their debt, and 251 if you don't account for the debt. Usually it's somewhere in between these two numbers, so probably like 230 would be their fair share price. And they might be able to do 5% growth. This would probably be their better case scenario. And in that case, they're still overpriced at 374. I would definitely not touch this business. In terms of discount rate, maybe we could do like a 5% return. Yeah, and we'd probably expect like a 5% return moving forward with Home Depot. If you bought them today, based on this model, you could probably expect a 5% return. If they do 5% growth, basically. If they do 3% growth, then you probably can't expect 5% return. Yeah, they're still overpriced at a 5% return. So yeah, this is a business that I think is overpriced at this point. I don't think that they're going to keep pace with the S&P 500, and I would stay away from this stock. So yeah, if you guys have any questions, make sure to leave them in the comments, and I will for surely answer them. Otherwise, hit that like button and that subscribe button because I do these analysis videos every single day, and I'll see you in the next video.